Hello everyone. So continuing with the discussion on the list of accounting standards which are relevant and applicable, like after IFRS 5 non-current assets held for sale, like which I shared that this is shown when we intend to sell any asset within 1 year from the date of classification. So next standard was IFRS 6 exploration for and evaluation of mineral resources. Now this standard is specially issued for mineral industry since there is a conflict with IAS 38 intangible assets. IAS 38 intangible assets has a way of recognizing or capitalizing the development cost but only on meeting certain criteria, which was not meeting with the mineral industry because they wanted this right to capitalize their E&E asset, exploration and evaluation assets earlier than meeting all those criteria. So they wanted to capitalize the moment they get the right to explore. So it was conflicting, so there was a new standard issued especially for mineral industry which is in progress, and we'll see some more updates around this in future. The next standard is IFRS 7 financial instruments. So as I shared that there used to be standards like IAS 32 financial instruments presentation, IAS 39 for recognition and measurement of financial instruments, and IFRS 7 for financial instruments disclosure. Two of the standards are retained: IAS 32 presentation. So IAS 32 is the standard for presentation, like it is for presentation and is supporting IFRS 9 for classifying between a liability and equity. So it is retained because this presentation was especially for classifying between a liability and equity, and this standard was still relevant and applicable. So it was not altogether replaced, but is going to continue to support IFRS 9 financial instruments. Recognition and measurement have changed. So IAS 39 is merged with or replaced with IFRS 9, we can say so. And the next standard, IFRS 7, is of continued significance even now relating to financial instruments. So these are the three standards now applicable for financial instruments. One is IAS 32, IFRS 7 and IFRS 9. The next standard which is relevant and applicable is IFRS 8 operating segments, which was being earlier done through geography or product or line of service. But it was decided that if the chief operating decision maker is reviewing something which is of continued importance, which is of significant nature, then that significant item or area of business which is of importance to the management should also be highlighted, and the users of financial statement should also be made aware of it. So there were concerns regarding confidentiality, why we should disclose what we are doing, what is our focus on, but it was decided in the interest of the users of financial statements that whatever the reason, we need to disclose the decisions of the chief operating decision maker. Some of the things are still carried forward, like the aggregation criteria or the quantitative thresholds still remain the same, but the management approach has changed a little, that we cannot decide on what basis we'll be sharing our segments. So whatever is of importance, like, will be presented first, and then the normal approach of aggregation, quantitative thresholds will be using for showing what is significant for us. IFRS 10 is the standard which is replacing IAS 27 separate and consolidated financial statements. IAS 27 was only separate financial statements. Now it was earlier separate and consolidated financial statements, IAS 27, but IAS 27 is left with only separate financial statements, and this consolidation process has now been shifted to IFRS 10 because there was a lot of confusion regarding the decision of applicability of consolidation. Now this is no more a decision on the basis of the voting power. The definition of control has been strengthened. It has been elaborated that there has to be a link between power and control, that if there is power over investee, if we can influence the decisions of the investee, we have exposure to rights and returns, whether we'll be receiving any variable returns, fixed returns. There is an assessment to be done on the basis of the control definition of IFRS 10 consolidated financial statements, so which makes it more elaborative and more comprehensive in terms of deciding the assessment, and it requires interpretation, thought, whether consolidation is applicable or not. Now, preparing consolidated financial statements is not a choice. That if an entity is controlling another entity on the last day of the reporting date, they have no choice. They are required to present consolidated financial statements along with standalone financial statements. So once it is decided that consolidation is applicable, then the procedure of IFRS 10 becomes applicable to it. But if there is an associate or joint venture which is decided through the standard IFRS 11 joint arrangements, which deals with taking a decision whether there is a arrangement. There could be collective control on an entity, but that collective control doesn't define an arrangement. So if there is a joint arrangement, whether this joint arrangement is a joint operation or a joint venture, IFRS 11 joint arrangements help us to decide. Now IFRS 11 is kind of replacing IAS 31 interest in joint ventures. That if it is a joint venture, it is supposed to be a separate legal entity, and there is no concept of proportionate consolidation for joint ventures. We'll do equity accounting. If it is a joint operation, we'll do line by line consolidation. So this standard on IFRS 11 is simply helping us, guiding us to make an assessment whether it is a joint venture or an operation. So depending on if it is a venture, IAS 28 investment in associates and joint ventures gets applicable. If it is joint operation, then line by line consolidation of IFRS 10 gets applicable. IFRS 12 is the standard for dealing with disclosures relating to consolidation. IFRS 13 is a special standard. Like earlier, the definition of fair value is the price that is exchanged between knowledgeable willing parties in an arm's length transaction. This was creating a lot of confusion. There was also a myth that when IFRS gets applicable, everything will be on fair value, which is not very true, because there are a lot of accounting standards which are still using cost model of measurement. Everything in IFRS will not be at fair value, because if everything on IFRS comes at fair value, then there is no need of the standard IAS 36 impairment of assets, because every year everything will be remeasured at fair value and the difference can be taken to P&L, which is not true, because the basic nature of some of the assets is to be consumed into the business. The intention is not to sell in the ordinary course of business. So if they are not going to be sold in the ordinary course of business, there is no point remeasuring them on each reporting date and taking the difference to P&L. Unless it is an investment property which is being measured at fair value, the intention is that we intend to hold it for capital appreciation and we intend to see the fair value in the market. We wish to also show the gain or loss on this investment property which is held for capital appreciation. So the intent needs to be very clear. IFRS is principle based accounting. It requires to understand the intent of the organization, why they are investing in a particular asset, why they'll be recording it, what is the purpose behind, or what is the purpose behind purchasing that asset. So I feel IFRS is very detailed, and one gets a lot of clarity if they're reading the financial statements, if they're reading the disclosures. One gets a lot of clarity looking at the items in the balance sheet and also the income statement. Now this IFRS 13 fair value measurement now comes with 3 levels of fair values. One is level 1, which is market approach. That is level 2, we observe the prices. If there is a similar secondary market available, we can take the prices from that similar secondary market and make some adjustments into it and can arrive at the fair value. And if there is no market, there is no quoted market, unquoted or similar market, then there is no option other than observing the price on the basis of projected cash flows and then arriving at the fair value on the basis of projected cash flows. Now the level 3 is the least relied upon. Level 1 is highly reliable. Level 2, when there is no quoted market, active market, we have no choice other than adjusting the price of something which is very similar in nature. Like if there is a market for one of the brand of cars like Hyundai or Maruti, and there is a similar secondary market for another brand of cars, so on the basis of the size of the car, whether it's a hatchback or sedan or an SUV, we can make some adjustments on the basis of the power of engine, whether it is diesel or petrol. We can make some adjustments and still arrive at the price of another vehicle which have a similar vehicle in the market which has a quoted price, even if it is second-hand car market. So IFRS 13 fair value measurement definitely helps in a lot of areas wherever fair value measurement is required, but there are few exemptions as well. To some of the areas it is not applicable, like fair value of present value of lease payments or share-based payments, it is not applicable. So it is very clear that where these three levels of measurement are supposed to be applied, there are some areas where they are not applicable. So it specifically mentions that these are the accounting standards will not be using IFRS 13 fair value measurement. So do not try to apply it everywhere. Be very careful that to which accounting standards it is applicable, to which accounting standards it is not applicable, and how it is supposed to be measured. So look for the highest and best use of an item, and then we try to arrive at its fair value. IFRS 14 is for integrated reporting about the governance structure of the organization, how they have been presenting their information, additional information other than what have been presented in the financial statements. So there are requirements relating to corporate governance. IFRS 15 is the standard which was really needed by the industry, because there were many accounting standards like IAS 11 construction contracts, IAS 18 revenue. The construction industry was confused, so there was an interpretation issued which guided them which accounting standard is applicable for them, whether it is IAS 11 is applicable or IAS 18 is applicable. So it was decided that if it is sale of goods, IAS 18 is applicable. If it is a construction, if it is something which buyer has control over design and specifications, then IAS 11 gets applicable. Then for customer loyalty programs, there was an interpretation known as IFRS 13. For transfer of assets from customers, IFRS 18. For barter transactions, SSC 31. Many interpretations, many accounting standards, creating a lot of confusion for revenue accounting. So there was a respite finally on 1st January 2018 that a 5-step model of revenue accounting was introduced. Even the world followed it. As I said, US GAAP also changed. They introduced a new standard known as ASC 606 to apply revenue accounting. Now revenue accounting is global in nature. If someone understands accounting for revenue, they can do job anywhere in the world. They can do revenue accounting for anyone based anywhere in the world, because the whole world uses IFRS 15 in IFRS and ASC 606. The next standard which was relevant and applicable, which is a dream of the chairman of ISB, Sir David Tweedy, that the day he gets a chance to sit on an aeroplane which is landed on the balance sheet will be a big day for the IFRS community. And it happened on 1st January 2019 when the aeroplane actually landed onto the balance sheet. Earlier what used to happen that these companies were buying these airplanes, but they were tweaking the contract in such a manner that it looked like an operating lease. The selling entity was selling the aeroplane, it was taking off from the balance sheet as sale of inventories from the manufacturer, but the buying entity was not allowing it to land it onto their balance sheet, because they were tweaking the agreement in such a manner that it was looking like an operating lease arrangement. They were able to show these expenses as operating lease expenses. They were able to keep away the commitments in the form of lease payments. There was no liability on the balance sheet. There was no asset on the balance sheet. So return on capital employed looked very good. Now this was supposed to change, and it actually happened, but it has also created a problem for other industries, because now everyone, whosoever is having an asset which is taken on lease for a longer term, everyone needs to bring all their items onto the balance sheet. Now other than the items which are short-term leases or low value items, everything now will come onto the balance sheet, and they also need to show their obligations. If there is a liability, they need to show their liability onto the balance sheet, which was a breakthrough in terms of fairer presentation for the users of financial statements. IFRS 16 is the standard which really takes care of substance over form. Legal owner may be someone else, but who is really benefiting from the use of that asset, they need to show that item onto the balance sheet. So this is the case. So this is the entire list of the IFRS standards which were issued after the year 2000. ISB issued them. So IAS and IFRS are still relevant today, still applicable today. There is no difference. The next standard which is replacing IFRS 4 insurance contracts is IFRS 17 insurance contracts. So IFRS 17 is the standard which is also applicable globally. Even US GAAP has developed their own accounting standards in line with IFRS 17, which is applicable globally. It was delayed a little because of Corona, but still all the industries now have implemented it. The next standard which is going to replace IAS 1 is presentation and disclosure of financial statements. Now this is changing maybe after 45 years. The standard is changing, presentation and disclosure of financial statements. This standard is going to make the preparation of cash flows very easier, because we were dividing the cash flows in terms of operating, investing and financing activities, and the same will be applicable to the financial statements in the income statement now. Now that is a good news for the preparers of financial statements, like who were getting confused while dealing with cash flow statements, like where we'll be showing these items, whether these will be shown as operating, investing or financing. So in some manner it is going to support the preparation of cash flows, because the income statement will also be classifying their incomes and expenses in terms of operating, investing and financing. That's a big change. Now this is applicable from 1st January 2027, but we'll be studying both the accounting standards. We'll be studying IAS 1 presentation of financial statements, because that is still relevant and applicable in the next 2 years. And we'll also study IFRS 18, the new accounting standard. Then there's one more standard issued which is relating to the disclosures of subsidiaries which are not listed. That is IFRS 19 is the new standard, which is specifically applicable, not applicable to everyone. So if there is a entity which is not listed, and if they are preparing consolidated financial statements, there is some respite being given to them in terms of disclosures. So this is the list of accounting standards. So while I was discussing this, I think you heard this word interpretation, SIC 31, IFRIC. So what is it? So while they were developing these standards from 1973 to 2000, there was a committee which was Standards Interpretation Committee, known as SIC. Whatever interpretations they were issuing in the name of SIC 1, SIC 2, SIC 3. Now some of those interpretations are still relevant and applicable even today. So those interpretations are still carrying the name SIC, but after year 2000, when ISB was formed, they formed a new committee known as International Financial Reporting Interpretation Committee, and they started issuing interpretations in the name of IFRIC, IFRS 1, IFRS 2. Like in the list we saw that IFRIC 15 is now replaced, IFRIC 18 is replaced, IFRIC 13 is replaced, SIC 31 is replaced. So we'll not see these SICs and IFRICs. As far as today's scenario is concerned, the IAC foundation is known as IFRS Foundation. They were supported by Standards Advisory Council, which is now IFRS Advisory Council, IFRS Foundation. So names go like this: IAC Committee became IAC Foundation, and today it is known as IFRS Foundation. In similar manner, Standards Interpretation Committee became IFRIC, International Financial Reporting Interpretation Committee, and today it is known as IFRS Interpretation Committee, because IFRS is the word like which is now globally accepted, everyone understands it. IFRS Interpretation Committee. The Standards Advisory Council is known as IFRS Advisory Council. So things are getting easier today. That IFRS Foundation is the monitoring body. they supervise International Accounting Standards Board, ISB, International ISB, International Accounting Standards Board. And they are supported by IFRS Interpretation Committee and IFRS Advisory Council. So how a new accounting standard is issued? IFRS Advisory Council will take applications for the issues which is being faced by the corporates and the countries or represented by the national accountancy bodies. So the relevance of national accountancy bodies is maintained, because without having a national accountancy body, ISB will not be able to function the way they are functioning today. So there are the representations from the national accountancy bodies globally, which are regulated and supervised by International Federation of Accountants. There again, IFRS Foundation is monitored by ISCO, by European Commissioner, by Securities Exchange Commission. So there are a lot of monitoring bodies which are also monitoring IFRS Foundation. Now these national accountancy bodies have representations. There are members who are part of ISB, and for an accounting standard to be issued, there is again democracy. Like if there are more members in support of issuing a but if some of the members are against it, why they are against it, their views are also shared with the users of financial statements, and why some of them were in favor, their views are shared, and the majority wins and a standard gets issued. There are exposure drafts issued, there are comments invited globally, there's a revision done again on the basis of these exposure drafts and comments, then the standards gets reissued, finalized, and there are improvements also being done in the accounting standards. The work goes on, and one accounting standard may take years, like 4 or 5 years, or maybe even 10 years to get developed. The work continues to go on because they have to be very careful. It is supposed to be implemented globally. It changes the material, it changes the content, it changes the content of the accountancy bodies globally. So how they maintained uniformity, how they maintained the relevance of these accountancy bodies globally. So what was decided? So the accountancy bodies who were having their own accounting standards and who were well developed, they decided to converge, means bring in harmony the national accounting standards. And adoption was done word by word, mainly by the accountancy bodies who were not very well developed and who wanted to apply immediately IFRS, and also benefit by telling the world that they're using IFRS, so the users of financial statements globally can rely on their financial statements, and if they're willing to invest in their country, they can invest on the basis of IFRS. The other national accountancy bodies decided to have their own words. Like in India, it was decided that we'll use the term IndAS for Indian accounting standards, which will be converged form of IFRS. Singapore decided to come up with SFRS, Australia ANZFRS, Bhutan came up with BFRS. In similar manner, Saudi Arabia have their own converged standards. Europe decided to come up